Oil prices are rising today on more geopolitical concerns, the usual sanctions stuff. Yet WTI remains firmly below $70 per barrel, as basically everyone in the energy sector is warning about a looming supply glut. You've got producers around the world adding back a few more barrels. At the same time, demand just isn't there. And we've got a contraction in Irish GDP, an economic warning from India, plus China being China, all of which reminds us about that demand side trouble. And since the Irish economy is made up mainly of those accessing its multinational corporate haven, Ireland is a reflection of global factors. The sudden drop in GDP in the second quarter, unexpected of course, is a warning especially for Europe where its ties are closest. Europe's output in Q2 is already expected to be flat at best, and perhaps this bumps up the chances of a negative European GDP print for the second quarter. India is the more immediate concern. With industrial output growth sliding even further, the second lowest in 3 years, it's a huge CPI problem, though, that has everyone worried the most, especially those at the RBI. And I don't mean for inflation either, as consumer price rates have fallen to their lowest since January 2019. No wonder the Indian central bank tried shock and awe rate cutting at its last meeting. And China is, well, China. Stop me if you've heard this before. More deflation, more foreign investment fleeing the country, no demand inside nor out. And on top of all that going on overseas, the oil supply glut concern got a huge boost from domestic information and data from the U.S. Energy Information Administration, which showed an alarming drop in gasoline supplied or demand, despite the fact that gasoline prices are much lower this summer during the peak season. Or is it that gasoline prices are much lower because demand isn't there? And that's what's concerning the oil space as more producers add more production back into the marketplace. Total Energies, in its quarterly report, the big oil conglomerate said last week, in an unstable geopolitical and macroeconomic environment, oil markets remain volatile with prices fluctuating between $60 and $70 per barrel. The market is facing an abundant supply that is fueled by OPEC Plus's decision to unwind some voluntary production cuts and weak demand that is linked to the slowdown in global economic growth. Refining petrochemical margins are similarly facing structural overcapacity given persistently weak demand. They keep referring to this. However, due to traditionally stronger summer demand, the driving season, refining margins are above $50 per ton at the start of the third quarter of 2025. And there's a little bit more going on in the refining margins than just that. But once the summer season fades, then the oversupply of crude starts showing up all across the energy space, from inventory to more and weaker prices. So some of this is going to be payback in the global economy too, and the oil supply space has been forecasting a supply glut since last year. Now, it didn't materialize in the first half of this year because of all the furious activity to make and ship and even store more stuff that was anticipating the trade war tariffs. But having pulled forward a lot of that demand, there's a lot less demand for the second half of this year, and that's what's got a lot of these energy producers concerned. They were waiting for an oil supply glut to show up because of the weakness in the economy, and all of a sudden a bunch of artificial stuff happened in between. And now they're saying, okay, well, now that the artificiality's done, what we're looking forward to is what we thought last year was going to happen in the first part of this year, looks more and more likely for the second part of this year heading into the first part of next year. The supply glut didn't go away, and instead, just like we talked about with the SOFR futures curve inversion in yesterday's video, it just moves further out in time because of so many artificial and non-economic factors. And as Bloomberg followed up with this report, both the International Energy Agency and the U.S. Energy Information Administration earlier this month bolstered their estimates for the surplus they see next year, oil surplus of supply. That's what they're talking about here. The two widely followed forecasters expect supply to eclipse demand by the most since the pandemic, with the IEA's projection at 2 million barrels per day. It's a stark contrast with the here and now, where inventories, and you hear this all the time, people talking about tank bottoms being scraped here, where inventories are at key storage hubs remain low, reflected in a bullish market structure that indicates tight supplies. Profits from turning crude into fuels are also far above seasonal norms, underpinning demand for crude oil. But one reason why refinery demand and margins has held up as much as it has is because of last year's supply glut that didn't show up when it was supposed to have shown up. Refining margins have held up simply because, anticipating the supply glut last year, refineries throttled back on production. We talk about that in videos from last year. With unexpected artificial demand in between, though, demand squeezed limited supply capacity and refining margins jumped here in the middle of 2025. So now refineries are drawing on some of the crude supply to fill in the gap, and in the process, they're opening maybe an even bigger one moving forward, which has got a lot of participants in the marketplace concerned about the downside for demand moving forward, even as we have more geopolitical ripples running through the entire oil market. And because of all this volatility and uncertainty, Eurodollar University has put together another subscription service, this time over at Substack. Every week, we're going to tell you what the one big theme is that you need to know about, and then dive deep into it, giving you all the background material from all across Eurodollar University's vast library of material about what's happening, why it matters, and what it means for the future. And you check out all the details behind that new subscription service, as well as some sale items on Eurodollar University memberships at our website, Eurodollar University. There's also a link in the description of this video to go right to Substack. As Bloomberg said, where inventories at key storage hubs remain low. And in fact, that's what the data shows too. Inventories of crude, according to the Energy Information Administration, or EIA, they're indeed low for this time of year. In fact, they're sticking along the bottom of a decade-long historical range, which goes back to 2015 and the shale boom. And this isn't an accident. And I've pointed this out at our deep dive analysis many times over the last couple of months. Over the past few years, producers and crude shippers have chosen to hold lower stocks. Now, why have they done that? Well, since 2022, they've learned to adapt to supply surprises, but more than that, they realize there is zero danger from demand. What I mean is, you only hold costly inventory when you think that somehow the global economy might suddenly hit a sweet spot and forget the forgot how to grow condition. In the forgot how to grow world, however, there's almost no chance oil producers will be caught flat-footed by a sudden and sustained burst of demand. So with no risk of upside demand and far more downside probability for demand, it makes economic sense to run on as thin of these costly inventories as possible. And with OPEC Plus realizing the same thing about demand, ditching its oil production cuts from the last couple of years, expecting recovery, there's the additional supply cushion on top of everything else. So then once we get past the spring and summer distortions and the artificial highs in economic activities, we get past the oversupply concern as some future property, and it starts showing up in real economic statistics as well as in the real economy itself. Now, the Energy Information Administration indicates that demand is tepid anyway, to put it kindly. Total petroleum supplied, which is a proxy for demand, their proxy for demand, it's averaging 20.3 million barrels per day here in the middle of July of 2025, which is the latest statistics that we have. That's less than the 20.5 million barrels per day and during the same week last year, and 20.4 million barrels per day during the mid-July of 2023, back when prices were a lot higher. You would think with lower prices, there would be more demand, but as I said in the introduction, maybe there's lower prices because the demand isn't there. And specifically with gasoline demand is even weaker than petroleum. Though there was a big drop in the latest data, and it might be statistical noise, but even before we got to that, demand was underperforming the past 2 years anyway. So Americans who are afraid for their jobs and incomes, they're not driving the way refiners had hoped. So whatever we make of the EIA weekly data, it's being corroborated by weak wholesale gasoline prices that are well below prior years for this part of the seasonal calendar. And if it's like this for what is supposed to be the world's cleanest dirty shirt, it looks even more concerning around the rest of the world, starting with Ireland. According to the latest report from the Irish government, the Ireland economy abruptly contracted during the last quarter for the first time since 2023. An ominous report before the Eurozone data, which is due out later this week. Gross domestic product shrank 1% in the 3 months through June after an increase of 7.4% in the previous period, the statistics agency in Dublin said on Monday. The strong start of the year was primarily due to businesses and exporters attempting to get ahead of expected tariffs imposed by US President Donald Trump. The second quarter drop was, quote, driven by a decrease in the multinational dominated sector of industry. That's the Irish government's statement. And Ireland is a reflection of worldwide conditions. It became a popular destination for corporate inversions in the 2010s and remains so to this day. And don't forget, it offers some of the lowest business taxes around. It is a tax haven. So for example, an estimated 25% of all leased aircraft that's flying around planet Earth come from a company that's located on the Irish island. Basically, there really is no more of an international component than at the margins of Ireland's economy, more than anywhere else, save maybe a few of the remaining tiny tax havens that are out there. So if it's happening around the world, it shows up in Ireland's statistics. And even before the inversion-rich 2010s, Ireland had been something of a warning signal transformed by these international trends. For example, an early warning about the seriousness of the incoming 2008 crisis was sent out by Irish GDP. It contracted sharply in both the second and third quarters of 2007, long before the idea of recession was even on the radar of anyone across the Western world. And Ireland, too, was one of the earliest signals of the forgot how to grow transition. From the upside of the supply shock to, well, they don't want to call it a recession, fine, to forgot how to grow. Irish GDP had turned negative in the fourth quarter of 2022, around the same time as basically everyone else, but then it was negative in 4 out of the 5 quarters to the end of 2023. After that, the initial forgot how to grow wave, GDP was lethargic in the first half of last year before the artificial blow-off in the second half, culminating in the big jump in the first quarter of this year on tariff beating. But now the big setback in the second quarter is a warning more than just for Ireland about the downside of the artificial high and how it wasn't a resilient economy at all. We're seeing evidence of that artificiality and therefore the payback. And given the close relationship with especially Europe, it's not a good sign for the European economy or GDP numbers that are coming out later this week. I think the more immediate concern, though, is from India. And I don't mean trade wars and the lack of a trade deal. India is one of the few remaining sources of growth around, especially the emerging market world, but that has been slipping since last year as well. According to the latest numbers out of India, industrial production there had slid to a year-over-year rate of just 1.5% in June. That's the lowest since last August, when the economy almost stalled completely, and the second lowest year-over-year rate since 2022. But like Ireland and really the rest of the world, India had been slipping into the middle of last year with that low last August, but then seemed to stabilize, at least modestly stabilize, with production getting back up to around 5% by January of this year. But since January, Indian IPs and its overall economy too, they have slowed down materially, which is why RBI went for its shock and awe rate cutting back in early June, surprising everyone, at least those who weren't paying attention, with a 50 basis point benchmark rate cut, plus promising to lower bank reserve requirements by 100 basis points. Now, RBI officials said they were being ultra cautious, and the data shows why they had been. It wasn't strictly about being careful or taking out economic insurance in the case of weakness. The weakness is already apparent in the economic statistics, no more so than in India's CPI. The CPI went through an unusual run of deflation, we'll call it deflation, where 5 consecutive months of negative CPI prints, negative month-over-month changes in the CPI, have left the overall yearly rate down to its lowest level since January of 2019. So India went through a highly unusual bout of weak and even negative consumer prices last year into this year, right around the time of the economic downshift. So the seasonal downswing for India's CPI was unusually strong and atypically negative, starting out with mainly food prices, but going on from there. So the fact that the index was negative for a shocking 5 straight months up until March was the reason that provoked the rate cutting from the RBI in the first place, and eventually the shock and awe in June. Because after those 5 months, those 5 negative months, the CPI, even though it's now positive for 3 consecutive months, it's been far less positive in the latest months than the same months of the previous years. Therefore, not only lower interest rates from the Reserve Bank of India, but lower economic potential all the way around, consistent with what we're getting from the oil market. In fact, India's finance ministry just put out a report that said, yeah, we're kind of worried about a slowdown. According to this write-up, the global slowdown, particularly in the U.S., could dampen demand for India's export, according to the finance ministry in its latest monthly report that was put out today. Continued uncertainty on U.S. tariff front may weigh on India's trade performance in the coming quarters. Again, it's not just interest rates that are heading lower here. In fact, India's rupee has been sliding too, very nearly touching a more than 4-month low, despite how everyone says everyone else is selling the dollar and selling America. India's rupee has been an important global currency canary in the Eurodollar coal mine for years, for decades, going back to 2008. And the rupee rose during the spring months of this year as artificiality throughout the global economy was at its apex. And now it appears to be weakening all over again, with increasingly negative swap spreads, for example, as I've talked about and pointed out, as concerns over the state of the global economy magnify and intensify, something that we can see in India, consumer prices, industrial production, as well as the rupee. And finally, China. China being China. China's industrial profits continued to fall in June, data showed on Sunday, as entrenched producer price deflation put more margin pressure on businesses in the face of subdued domestic demand, and they call it lingering global trade uncertainty. It's really just a lack of demand from outside as well as inside. Now, China's economy slowed less than expected in the second quarter, at least according to GDP, and a show of what they say is resilience to U.S. tariffs. But punishing price wars among producers have prompted Beijing to pledge tougher regulations for autos and solar panels, among other industries engaged in cutthroat competition. And it's only cutthroat competition because what they call lingering trade uncertainty is not really lingering trade uncertainty. It is the lack of demand. They can label this oversupply or overcapacity, but it's only oversupply and overcapacity in the context of demand that just isn't there. Demand that isn't there and is becoming less and less as we move through time. So the issue isn't oversupply, it's under demand. Just like we see with crude oil, it's the lack of demand which removes the support for prices. And with little forward momentum or any global growth catalyst, certainly not lower interest rates, foreign direct investment in China has accelerated its decline to minus 15.2% year over year for the first half of 2025 compared to the first half of 2024. And let's not forget, foreign direct investment in the first half of 2024 was nearly 30% below investment in the first half of 2023, which was itself 2.7% below direct investment in the first half of 2022. So you've got compounding negatives because there is no demand around the world, nothing which looks like it has a chance of sparking a real recovery or even stabilization. Despite the constant stimulus from Chinese authorities and now 15 months of global central bank rate cuts, many of them significant, the world is not stabilizing or recovering. It only remembers how to shrink, forgot how to grow in a different phrase. And so all of us forgot how to grow is just more evidence inarguably showing rate cuts don't stimulate, bazookas don't fire. They're only ever a reflection of the weakness that's showing up in all of these places in all of these different ways and in the current plus future pricing of crude oil. So even with all of these artificial factors in the price of crude oil and the short-run fluctuations that go along with geopolitical risks, don't call it a supply glut because it's not really a supply issue. The real issue is demand. Global central bank policies, intentions, and forecasts like those from the FOMC and Jay Powell, as well as the Bank of Japan, all of which is creating uncertainty in rate markets, and I went over all that in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's Substack subscription service, link in the description. And huge thanks to Eurodollar University members and subscribers. And until next time, take care.